Welcome everybody to the latest episode of our crypto trading crash course. On this episode, we want to finally answer the number one question we get asked every week here at the Prime XBT Trading Academy. How do I find the perfect stop loss and the perfect take profit? Now, this question, as I sadly have to say, cannot be answered by a simple process to determine a stop loss or take profit on the chart. However, there is a method, mathematically based method, I should say, that I want to present to you today, how you can determine if your stop loss and your take profit in the long term actually make sense for your trading. I want to show you this by a real-life example that I just recently posted on the Bitcoin US dollar chart, where I found a so-called Bitcoin squeeze pattern. So that means when the Bollinger Bands are contracting here, the green and red line, very, very closely, and we see the price breaking out to the north. Now, we saw this pattern resolve to the north and saw a dynamic breakout over this green Bollinger Bands here on the 19th of July. I made a video about this pattern as well, by the way. I also talked about this pattern on our Discord channel. If you have not joined the channel, look into the description of this video. You will find a link there to join us. Now, I would never blindly enter a trade just because there is a signal. The next step I have to do is to determine where would be a good zone for my stop loss and to what price could this pattern actually play out. So what is my take profit target for this trade? And I did so by determining that a good zone of stop loss would be here around 21,000 US dollar. And from my experience, a pattern like this has quite some dynamic, and if the dynamic progresses, the minimum target for this pattern would have been 28,000 US dollar. Now, I need to determine, is this actually good having a stop loss at 21,000 US dollar and a take profit at 28,000 US dollars? And I did so by calculating my so-called risk-reward ratio. Risk-reward ratio means how much money do I have to risk to gain a certain amount of reward. And I'll show you this on the chart here now, how that works. So since I wanted to enter the trade at the end of this candle piercing out of the Bollinger Bands, I wanted to enter the trade at around about 23,500 US dollar. Remember, my minimum take profit target for this trade is 28,000 US dollars and my stop loss was at 21,000 US dollars. Now what you see here in this green box is my profit potential. What you see in the red box underneath is my loss potential. So that means if I would have chosen a trade side of, let's say, 100,000 US dollar tokens for this trade, I could potentially have earned 4,500 US dollar, 28,000 minus my entry at 23,500 and risk 2,500 US dollar, 23,500 my entry minus my stop loss of 21,000 US dollar. So the first thing you can see here very clearly is that my potential profit is much larger than the amount of money I'm willing to risk here. The green box is bigger than the red box in this case. And this can be translated into something that is called a risk-reward ratio. In this case, my risk-reward ratio is 1.8. And you can calculate this very simply by taking your potential profit, in my case 4,500 US dollar, and dividing it by your potential loss, in my case 2,500 US dollar. So 4,500 divided by 2,500 is 1.8. Now, what does that mean? This means for every US dollar I'm risking with this trade, I can potentially earn $1.8. And this is a basic principle that you probably automatically would also apply for every business you are doing. You probably never would run a business by, let's say, sell shoes or groceries or products on Amazon, where you are risking more money than you can actually earn. Nobody, probably no businessman or businesswoman in their right minds probably would do that. However, when it comes to trading, people en masse make choices where they, for example, want to earn 1,000 US dollars but are risking 10,000 US dollars. And mathematically speaking, over the course of, let's say, 100 or 1,000 or even 10,000 trades, this will very likely lead to the destruction of your portfolio. Because imagine, if your risk-reward ratio is a 1-to-1, that means for every dollar you risk, you can earn $1. Well, in order to break even, you just need to be correct 50% of all the time, then you wouldn't lose money. So this is basically a coin flip situation. However, if you, for example, risk $1 and to get a reward of $2, you only would need to be correct in 34% of all your trade with all your trades in order to not lose money. You put already the probability into your direction, so you can actually be correct less than 50% of all the time with your trades and still earn money. And this is the big difference of how professional traders or trading institutions like hedge funds, like banks approach their trade. They will always try to choose the trades where the earning potential is much higher than the loss potential, because they want to put the math on their side. No professional trader out there is correct 70 or 80 or 90% of all the time over the course of, let's say, 3, 5 or 10 years. If you are there somewhere between 52 and 55%, you're already amongst the top 1% of the traders worldwide. Now, in my case, with this risk-reward ratio of 1.8%, it would mean if I choose this risk-reward ratio for every trade out there, I only need to be correct 35.7% of all the time with my trades in order to not lose money. So there's a good chance, just from a coin flip situation already, that I end up earning money. And I apply this principle to all of my trades, at least to all of my swing trades. When you're trading intraday, it might be different, but more on that on a later episode of our crypto trading crash course. And try to apply this to yourself. So the first step you should do is see, where are you entering the trade? Where is your potential take profit, where you want to exit the trade with a win? Where is the stop loss, where you would be willing to exit the trade? And if this, then calculate the risk-reward ratio, and you can do this, for example, here on TradingView with a tool as well that does that for you. And if the risk-reward ratio is at least 1.5, then you have a good trading setup and you have found a trade that is, mathematically speaking, worthwhile entering. Okay, I hope you had as much fun watching this episode as I had making it. If you like this episode, please give us a thumb up and subscribe to our channel. I'm going to see you on the next lesson of our crypto trading crash course. Until then, stay safe, take care, and bye-bye.